202.62%. I know, right? It sounds made up, but that is not a typo. And no, we're not talking about some overnight speculative crypto coin here. We are looking at the absolute staggering 3-year total return of Victory Capital Holdings, ticker symbol VCTR. Now look, when a stock literally triples in value in just 36 months, well, it's going to turn some heads. But as focused learners, you and I know better than to just blindly chase a soaring chart. We really need to look under the hood here. So in this explainer, we're going to unpack the massive data set behind the company's financial health. We want to see exactly what is driving this exceptional number and, honestly, more importantly, figure out if this underlying engine is actually strong enough to keep on running. So welcome back to the explainer. You know I absolutely love digging into the numbers. And man, today we've got a seriously rich set of financial data to analyze for VCTR. What we're going to do is transform this giant wall of data into a super clear, structured scorecard. By visualizing all these metrics side by side, we're really going to make sense of where VCTR actually stands financially. All right, let's break this whole thing down. Grab your notes and let's jump right in. To keep us totally focused today, here is our agenda. First, the incredible growth story. Second, profitability and efficiency. Third, decoding VCTR's valuation. And finally, dividends and debt. All right, Section 1, the incredible growth story, tracking VCTR's upward trajectory. Okay, so just to establish our baseline here, let's take a look at the current scale of the company. Right now, VCTR is sitting at a stock price of $85.48. That gives it a very healthy market cap of over $5.3 billion. And just look at that momentum for a second. A year-to-date return of 36.47%. Honestly, in a market where a lot of companies are really just struggling to find their footing, VCTR has literally been sprinting. Okay, let's dive into this. When we zoom out a bit from that year-to-date metric, the historical context paints this crazy picture of intense compounding growth. So, we've got that solid 36% year-to-date, right? But then that jumps to a 202% return over 3 years, and a seriously impressive 239.14% return over 5 years. So what this tells us is that VCTR really hasn't just been a flash in the pan. They've been consistently rewarding their shareholders over the medium and long term. But here's the thing. A stock price doesn't just climb in a vacuum. Or, well, at least it shouldn't. It really needs to be backed by actual, tangible business growth. And it turns out, VCTR's fundamentals actually do support this massive rally. Their trailing 12-month revenue is sitting at nearly $1.5 billion, and that's driven by a 3-year compound annual growth rate of over 21%, which is great, but even better, their earnings per share has grown at over 23% every single year during that exact same 3-year period. You add in a super robust $421 million in trailing free cash flow, and yeah, you can really see the fundamental bedrock that's supporting this stock's crazy trajectory. Moving right along to Section 2, profitability and efficiency, under the hood of VCTR. Now, to actually measure that efficiency, we rely pretty heavily on one specific metric. And let me just briefly translate the finance speak for you here. Return on invested capital, or ROIC, is basically a measure of the company's engine efficiency. It simply tells us how well the company is using the money it's raised to actually generate profitable returns. You can kind of think of it as a direct scorecard for the management team's decision-making. And VCTR, well, they score 12.52% on that metric. But you know what's really fantastic about this number? It's not just the absolute value, it's the trend. This current ROIC is actually nearly 5% higher than its own 3-year historical average. So that indicates that as the company has been growing its revenues, the management team has actually become even more efficient at deploying their capital. That's exactly what you want to see. And a huge chunk of that efficiency, it comes directly from their margins. VCTR boasts an absolutely staggering 82.84% gross profit margin. I mean, wow. This means the direct costs of their operations are astonishingly low compared to the revenue they're bringing in. And crucially, this isn't just some lucky one-off spike. The data actually shows this is highly consistent with their historical 3-year average of 82.47%. However, our job here is to look at the whole picture, right? And this is where we have to introduce a little bit of tension into the story. While their ROIC has definitely improved, their return on equity, or ROE, is currently sitting at 12.46%. And that is actually down. It's down a pretty significant 34.44% compared to its 3-year average. So, what's the takeaway? Well, while they are definitely efficient with their total invested capital, the specific return they're generating for shareholders' equity has actually softened up a bit compared to the recent past. All right, on to Section 3, decoding VCTR's valuation. Is the price actually right? Now, what's really interesting about this slide is that we uncover a pretty stark clash between two completely different valuation models. See, if we try to price VCTR based on an earnings per share model, the fair value comes out to $69.57. And with the stock currently trading up around $85, well, that gives us a negative margin of safety of almost 23%. So, in other words, going by this specific metric, the stock is overvalued. But, and this is a big but, if we price the company based on a free cash flow model, that fair value jumps up to a remarkable $154.37. That gives us a massive positive margin of safety of over 44%. This crazy contrast right here, this perfectly highlights exactly why we always look at multiple data points. The earnings are telling us it's expensive, while the cash flow is screaming that it's a significant bargain. So, to try and get a clearer picture of what's going on, let's look at how the market is pricing VTCR relative to its own history. Right now, VTCR is trading at a price-to-earnings, or PE ratio, of 19.17, and that is a 30.22% premium compared to its 3-year historical average of 14.72. Honestly, that definitely lends some weight to the idea that the stock might be running just a little bit hot right now. But then conversely, if you look at the price-to-book ratio, it's essentially flat. It's just sitting at a really slight 3% discount to its 3-year average. And just to add another layer of complexity to this whole valuation puzzle, we have a highly negative PEG ratio of negative 28.68. Now, remember, the PEG ratio factors in growth, and when you see a deeply negative number like this, it usually points to some kind of anomaly in recent earnings growth, relative to the multiple. For the bears out there looking at this stock, this is a super compelling data point. It gives them a really strong argument that the stock's current valuation has kind of disconnected from its underlying stabilized growth rate. Moving to our final pillar, Section 4, Dividends and Debt, Rewarding the Shareholder. Okay, let's start off with the balance sheet here, because honestly, we are seeing a definitive win for the management team. Right now, VCTR's debt-to-equity ratio is sitting at a very healthy 0.41, but the real key takeaway here is the comparison. Over the last 3 years, that average was 0.74. Think about that. That means management has been aggressively cleaning up the balance sheet, dropping their relative debt load by nearly 45% compared to their own historical averages. I mean, you gotta hand it to them. That is just incredibly sound financial management. And hey, because their balance sheet is in such great shape, they can actually afford to reward their long-term shareholders. So let's rapid fire through VCTR's incredibly impressive dividend profile. Ready? They currently offer a 2.34% dividend yield. And what makes that yield so attractive isn't just the number, it's the safety net behind it. They're only paying out 43.11% of their earnings to cover that dividend, which leaves them plenty of room for future reinvestment. But for me, the most exciting part is the growth. We're looking at a 16% compound annual growth rate on their dividend over the last 3 years, and that is backed up by 7 consecutive yearly increases. Now, if we take that aggressive, double-digit dividend growth and project it forward, the math gets really fascinating. Just look at the forward yield on cost if you were to buy the stock today. In 3 years, your effective yield jumps up to 3.11%. In 5 years, it's approaching 4%. And if management can actually sustain this pace, in 10 years, your yield on your original cost would be over 6%. That right there, folks, is the absolute magic of a compounding, well-supported dividend. And so that brings us to the ultimate question. We've seen the phenomenal 3-year returns, those crazy high gross margins, and the rapidly growing dividends. But on the flip side, we've also seen a pretty big clash in fair value models and a PE ratio that's definitely running about 30% hotter than usual. So what do you think? With a 36% year-to-date return already in the books, is Victory Capital's future growth already fully priced in? Or does that super robust free cash flow mean this engine is really just getting warmed up? I'll leave you to weigh the data on that one. Thanks for joining me on this explainer, and as always, keep learning.